Well, good morning, everybody. That was a great intro to this fabulous hour that we're going to spend. My name is Bill Hitchcock. I'm the Senior Vice President of Business Development here at Atlantic Bay Mortgage Group. And I'm super excited for our lineup today and want to jump right into things. So first off, I want to introduce our Chief Lending Officer, Miss Emily Farley Gardner. She is a alumni of Virginia Tech. She was there when they were actually good in football, but she is still a proud alumni there, and she has been guiding the ship here at Atlantic Bay for quite some time, and gets to really lead our fabulous group here. And our community and our mortgage community is really appreciative of all the work that she does, and especially with one of her big passions, rock solid foundation. So, Emily, welcome.
Thank you, Bill. We appreciate it. We're really honored to have an amazing guest with us today. As you all know, I'm a very big fan. We have Logan Mohtashami here, who is the chief analyst for HousingWire and a renowned expert in the mortgage industry. And one of the things I love about him is he actually has been in the industry and understands us, not alone, along with the sales side and the economic side of the industry. And he has over 2 decades of experience doing that. He's nicknamed the chart guy. And if you guys haven't listened to him on HousingWire Daily, I start my day with him multiple times a week. And I absolutely love how he brings not only amazing information, but humor with it, with his Gandalf line, with his analogies of the Fed, with his slow dance of the 10-year, which we may hear some of this today. I'm not really sure, but he has an amazing way to decipher complex information and really put it out in a way that is understandable and digestible. And he's done a ton of things and a really sought after commentator in the industry, with tons of news outlets on CNBC, and is a frequent guest on many other outlets. He takes the data and really analyzes in a way that I love and puts out a weekly tracker so we can really see, what's happening, where we've been, and, where we're going. So I'm extremely honored to welcome Logan Mohtashami to our Engage series today. Welcome, Logan.
It is wonderful to be here. And yes, we're all going to nerd out. And I always say, I have kind of 2 sayings. Economics done right should be boring. I try to make it as entertaining as possible so all of you can understand the housing market and, relay it to your clients. And I always say everyone has an Uncle Dave that thinks it's Housing 2008 every single Christmas and Thanksgiving. So my job is to give you guys the data in a way that you can talk about it in an easy fashion, because if my, really smart economic friends are asking me what's going on with housing, then everyone's somewhat confused out there. So today's data is going to give you a story with facts, and then you could relay that to anybody you talk to.
And just really quick, Logan, as you pull up your slides, we will be holding questions at the end. If you guys have questions, put them in the Q&A, put them in the chat. Thea's going to be getting those over to us, and Logan will answer those at the end. So forgot that housekeeping.
All right,
Ashley,
let's go. Okay, for those who don't know me, Logan Mohtashami, lead analyst for HousingWire. Our family's been in banking since the late 1950s. My father opened up his own mortgage company in 1987. I got into the stock market in the mid 1990s, joined the family business. I was an LO up until I retired in early 2020. My father's still in the business, so I do understand what everyone is going to. I started writing about housing economics in 2010. One thing led to another, and I'm here today, and hopefully this presentation today will give you an idea of what is going on. So we can start with the first slide. Okay, the slow dance. If I'm at an event right now, I would ask everybody, how many people here have been married for over 20 years? The 10-year yield and the 30-year mortgage have been in a lovely slow dance since 1971. So to understand where mortgage rates are going, you're going to have to understand where the 10-year yield is going. I know the mortgage-backed security market is very important, but that's not how I track mortgage rates. I usually give people forecasts at the year, but I give people ranges. I don't ever really target, because as you can see here, directional changes move with this. And what drives this? Economic data, inflation expectations. The 1970s, of course, had a lot of growth on year-over-year inflation. That has kind of changed. And then we had COVID, right? The history of global pandemics, they're very inflationary early on. And then people will overreact to the inflation like the Fed has done. And then the disinflation happens. There's nothing abnormal about that. That's global pandemics, of course, because supply chains don't work. The same thing when countries go to war. So as you can see here, our problem in the real estate sector is that the 10-year yield is too high and mortgage rates are too high. It's not because people are underwater with their mortgages or credit is getting really too tight. The 10-year yield moves the housing market. Whenever the 10-year yield rises, purchase application data gets hit. When it falls, like we've seen even in the last few years, purchase application grows. The Fed is overly restrictive right now, especially toward housing. Once that changes, demand will pick up. And whenever we see rates fall, like we did at the end of last year, and especially even at the end of 2022, demand picks up. And we are working from very low levels of sales. A lot of the charts will give you this, but this is it. This is our issue right here. 10-year yield falls, we'll get there. So the next slide will show kind of how I look at the 10-year yield and mortgage rates. Now, a lot of people thought last year, because inflation was going to fall, that the 10-year yield and mortgage rates were just going to go back to what it used to be. Global bond yields are high. The growth rate of inflation is still high. But as you can see, we had lower 10-year yields and lower mortgage rates when the growth rate of inflation was peaking, right? So it doesn't necessarily work one-to-one. So going into 2023, the 10-year yield had been falling late 2022, but I thought we got to a level that I didn't think we could break because the economic data wasn't breaking. A lot of people thought we're going into a recession. So I thought, what's the best way to relate to all of you? And I'm not kidding. I literally brought Gandalf the Grey in January of 2023. And I see that red line there. We're not going to pass that. Unless the economy is breaking, where we shouldn't pass that. That line got tested 8 times. One day we did break it. It was the peak of the financial banking crisis. So when we think about mortgage rates, don't necessarily think about mortgage-backed securities or inflation has already fallen, so we should go. Think about economic data right now. If the labor data starts to get weaker, trust me, the 10-year yield will start to break down. So when I look at 2023 and going into 2024, 4.25 on the top, that's that red line in the bottom. That should be the high point level. 3.21 on the bottom, and that Gandalf line is about 3.37. This means if the spreads are as bad as they are right now, 5.75 to 7.25 in mortgage rates. What happened last year where we broke that line is the Fed made a very, very bad mistake. The growth rate of inflation had fallen. The economy was growing really good in the third quarter, 5% GDP. Jobless claims were falling. We could thank Taylor Swift and Barbie for having people spend money on them. That was kind of a one-off. And then the Fed went very hawkish for some reason. And then after that, we could see the 10-year yield shot up to 5%. Mortgage rates were at 8%. I know for a fact that they were panicking about that, because if you saw the Fed presidents are like, well, why is the 10-year yield going up? Why is mortgage rates going up? You know, you went hawkish in a time you shouldn't. So after that, in a sense, sometimes this is a blessing in disguise. The Fed realized we should stop being overly hawkish. So some people think the Fed has pivoted. I don't believe so. I believe they're still extremely restrictive. The growth rate of inflation has fallen. So they can change everything for the housing market if they want to. They choose not to, because I always say the Fed is old and slow. It's just the nature of the beast. They're late to a party, and when things are when they should be cutting, they're still moving too slow. So things should be better as the year progresses, but we have limits to what mortgage rates can do as long as the economy is firm. So the one variable that is different this year that's going to be was a problem last year. The next chart will show this. It's the spreads. So this is the spreads between the 30-year mortgage and the 10-year yield. During the previous decades, the spreads were good. So in a short way to talk about this, mortgage rates should be up 1% lower today, right? And whenever we have stress in the marketplace, the spreads get very wide. So right now, mortgage rates are not only too high in relationship to inflation, but they're also very high in the spreads. If you noticed that little V shape that I created there, the spreads were getting better last year. And then the banking crisis happened. And then as the banking crisis happened, market stress, spreads got worse. right? So we had a V-shape move in the spreads. Mortgage rates got more restrictive. Worst time in history to have that happen, especially right now, but that was the case. The Silicon Valley Bank issue actually hurt the US housing market. It got worse. However, right, if we go back decades, if I took this chart back 4 or 5 decades, the spreads do eventually get better as there's less risk, EPO risk, less risk in the marketplace. So we're seeing the spreads starting to improve now. If this gets better by itself, we could be 1% lower today and not have the 10-year yield go down to go with it. So that's where the slow dance, get closer, get wider. We can get much closer, much more romantic in that slow dance if the spreads get better. And if the Fed starts cutting rates, the Fed can say one sentence and change this entire market. They choose not to, but this could be a positive, especially going out in the year. So we do these trackers every single week. We give people these, what's the 10-year yield going? Right now, it looks pretty normal. But if the labor data does get softer, bond traders will push this 10-year yield lower like they did toward the end of 2022. A lot of people thought we were going into a recession. Bond traders took bond yields lower, mortgage rates fell, but we weren't breaking as an economy. And now we're just kind of hovering this expansion. So this is a key data line to track for the rest of the year because mortgage rates can get better faster if the spreads get better. And we never know. The Fed might surprise us by trying to be pro-housing for a change. So we'll go to the next chart.
And Logan, can I interrupt you for a second? We've got some partners on here that are maybe not super familiar with the 10-year yield. Can you take 2 seconds to kind of explain what that is, that data line?
Yes, the 10-year yield is the bond market where people borrow money for 10 years. So there's 2-year, 5-year, 7-year, 10-year, 20-year, 30-year bond market. That's where we basically government borrowing is. That's more of the longer term on a 10, 20, 30-year bond. And then there's short-term rates where the Fed funds rate really matters. So when the Fed raises rates, the 2-year yield tends to go up with it, the 5-year yield. So when we think about the 10-year yield, think about long bond market, government borrowing longer, and then the Fed funds rate moves with kind of the 3-month, 2-year, 5-year. That's where the Fed funds rate really matters. But for the long end, again, a lot of economic data kind of moves it. They all typically trend together, the growth rate of inflation, economic growth, the Fed funds rate. I just think that last year people thought because the growth rate of inflation was falling that the 10-year yield would go, but there's limits to that. So that's where the government borrows, or we own most of our debt in this country. People think China owns our debt. No, they don't. So anybody that buys treasuries, Wall Street, pension funds, other countries, the Federal Reserves, that's where they're borrowing on a 10-year rate. And now the key data line for me and my economic work and for everything, this is jobless claims. The history of economic cycles have told us that when jobless claims break above a certain percentage, the US goes into recession. This data line, if it gets above 323,000 on the 4-week moving average, we're going into recession. So it was rising last year, but it never kind of broke there. And as it was falling, bond yields kept on going up. So this is actually a very good data line. Comes out every Thursday, 5:30. Now, what happened a few months ago, the history of economics have told us this. When the market believes the Fed is done hiking rates, it actually rallies really big. That means bond yields rally, people buy bonds, mortgage rates go lower. The only time that didn't happen was 1978. So the move that we saw looks right. But the growth rate of inflation is really low. The economic data is still firm. If this data line starts to go higher, you're going to hear a lot of excuses why mortgage rates can't go lower. This will drive mortgage rates lower. Bond traders will push the 10-year yield lower. They'll push mortgage rates lower. But as of right now, the jobless claims data, these are the people filing for unemployment and collecting benefits. It's still very low historically, especially against the civilian labor force. So this to me is the key data line as of right now, because if this breaks, see, I think the Fed should be cutting rates now so we don't get to the point of this breaking because the growth rate of inflation is falling. So every Thursday, 5:30, this is the key data line, because if this goes higher, mortgage rates should start to go lower. And always remember, during COVID, a lot of my friends, smart economic friends, were telling me, why are you so bullish on housing? There's 20 to 30 million people unemployed. And I go, that's really cute. I've got 133 million people still working behind me and mortgage rates are at 3%. Why wouldn't they buy homes, right? The housing market doesn't necessarily need 20, 30 million home sales, right? Trend sales for decades is running on 5 million. So what occurred is that people saw the unemployment rate and then all of a sudden mortgage rates got lower. They thought nobody would buy homes. We shot back in 6 weeks. For those who don't know my work, I wrote a recovery model on April 7th, 2020. HousingWire was kind of questioning, should they even publish that? I thought the US was going to recover there. So when rates fall, just remember, housing gets disproportionately impacted when rates go up. Like in 2022, we had 4 million jobs created, but rates went up too high. It also gets disproportionately impacted to the good side when rates fall. So this data line here to me is the key of everything. And right now it still looks good. We'll go to the next chart. This is job openings. Okay. This is a fairly new data line for a lot of people. This has been a very near and dear data line that I track for myself and all my economic work in the previous decade and then in the COVID-19 recovery. One of the things I did during COVID is I kept on tweeting and talking about job openings are going to get to 10 million. So think about it in this way. The baby boomers are leaving the workforce every single day, every single month. They need to be replaced. So naturally, as a country gets older and population growth slows, job openings data should rise. Okay, so you'll take that little, I draw these black lines on a lot of my charts. The Fed loves this data line as well. Job openings got to 12 million, but it's back to where it should be, right? So the Fed overhiked thinking that this was going to create wages to spiral out of control. It didn't, right? It was a global pandemic. There was a lot of distortions in supply, labor supply, everything. It's back to normal already. The Fed should cut 75 basis points in the next meeting because this is the data line that they told us they wanted to track. And the next chart is actually going to show you the key important data line in the job openings. This is the quits ratios, right? The Fed freaks out when people quit their jobs to go work for higher paying jobs because that push wages up. So the Fed does not like wage growth getting too hot. For people making more money is not a good thing in their mind. This data line is already back to pre-COVID-19 levels. Okay, so the labor market is pretty much back to normal in my mind. Fed should cut 75 basis points next meeting. This is the key data line for them. So if the Fed starts to sound a little bit more dovish lately, it's because this data line is back to normal. There's going to be less bidding for wages. The Fed freaks out when wage growth gets too high. So this is a positive for the housing market, especially going on for some time, because it's really hard to get the quits ratio to accelerate higher. And let's go to the next chart. So the employment data, okay, so this is another thing, a part of my economic work. A lot of people were surprised that we had these really big job prints, but for myself, if you look at what happened at COVID was an anomaly in terms of all economic data. We don't usually have waterfall dives like this, right? But as of April of 2020, everybody started living their life again, and we started to shoot back up higher. However, one of the things I've talked about over the past few years, we're going to get back to a normal jobs market once we break over 157 million people working. We just recently done that. Population growth is slowing. We can't really have really big jobs report. If there was no COVID-19, assume COVID never happened, we would have already been there already. So the big job reports are kind of over. Job growth should slow down. Quits ratios is slowing down. We're getting back to a normal pre-COVID labor market. The Fed shouldn't freak out. They should be cutting rates because things are getting back to normal. COVID, as you can see here, very glaring. It really distorted a lot of things. Getting back to normal, getting supply chains back to normal, getting the labor data back to normal is going to be a positive for housing because the Fed's going to eventually realize they overhiked, and job growth should slow down. We should be running at, at best 140,000, 160,000 jobs per month. Eventually, over time, that'll even go under 100,000. Remember, population growth is slowing here. The baby boomers leave the workforce. So the labor data that the Fed was concerned about, as you can see here, is pretty much back to normal. We don't need to stay restrictive. with policy. So this, to me, I believe all of this is a positive for housing, because I think the Fed realized that they might have overhiked here. That'll be good once they start making more positive comments. Next chart. Okay, inflation. Okay, this is the consumer price index. The Fed likes to track the PCE, but this gets a lot of weight here. The growth rate of inflation. Inflation is always rising, right? We're not a deflation economy, but the growth rate, you know, if I took this out to the start of the century, it's really hard for core inflation, the purple line, to get above 2% and stay there, except, COVID, right? The history of global pandemics, very, very inflationary early on. And then the disinflation happened. This is where the Fed really screwed up, because there's a lot of people, Larry Summers and others, said you need a job loss recession to bring the growth rate of inflation down. No, you don't, right? The unemployment rate is under 4%. Jobless claims are low. Job openings are high. The labor market is fine. Stocks rebounded, and the growth rate of inflation fell by itself, because this is what happens with global pandemics going 400 or 500 years, right? We have the inflationary part and the disinflationary part. Now, housing, rents, right? Home prices don't really filter themselves into the inflation data. If I took this chart back to 2000, during 2002 to 2005, the growth rate of inflation was barely at even 2% for core inflation. So home prices don't filter here, but rents do. Rents are the big drivers of inflation. Growth rate of rents are already negative on some parts. So this inflationary data that we see right now is artificially held up. The Fed overhiked without rents taking off again. So you need a booming economy and supply to be low. We're getting lots of supply coming into the rental market. The Fed should be cutting rates. That was like the employment chart, very, very inflationary early on. The inflation thing is over. It's very, very hard to get accelerated growth rates of inflation unless the economy's booming. You have major labor force. When we talk about oil prices, the 1970s, adjusting to inflation, oil would have to be $450 today to match that. So they overhiked. I'll forgive them as long as they realize they need to start cutting soon and be more positive, because this was supposed to never happen until we got a job loss recession. No, the labor market still stayed fine. Stocks rebounded. We still have $1 trillion in excess savings. And this happened by itself. And over time, the growth rate of inflation should kind of get back to normal, unless we have another war or supply drift. I know there's issues with the Red Seas, but this is a very important chart to look at it on a year-over-year basis. This all happened with the labor market not breaking. So the Fed overhiked. They need to start cutting rates. They need to start to be more pro-housing. And this data line is very clear. I always present this in this manner, that we were told this could never happen without a job loss recession. It did. All the Fed members should write apology letters to everybody right now just based on this. Next chart. Now, existing home sales. So this goes back to the year 2000. If you guys look at 2002 to 2005, that was a massive credit sales boom. Right. The housing bubble was many years of credit growing. And after 2010, with qualified mortgage, we can't really have a credit boom ever again. So we started growing sales for a long time. My economic work for housing was separated in 2 years, 2008 to 2009. I always said we would have the weakest housing recovery ever, because household formation has to work its way up. The millennials are going to start buying homes, but by years 2020 to 2024, housing demand should get better. The only problem that could happen in years 2020 to 2024 is that inventory can break to a very unhealthy level. There's going to be some charts that I go over with that you could show your clients. Home prices escalated out of control, and we broke my own affordability model. The unhealthy housing market became the savagely unhealthy housing market. And then when rates rose up, you could see what happened here. Literally the fastest and sharpest decline in home sales ever recorded history. What took, 2005 to get to 2008, 3 years, 12 months, right? Also, not only was it the fastest crash, a lot of people thought that, home sales could go down to 2 million. Well, after 1996, as you guys can see here, it's really rare in America to have home sales, existing home sales trend below 4 million. It's been a big part of my work. It's one of the reasons why I thought housing was going to, the dynamics of housing were going to shift on November 9th, 2022. That waterfall stopped around 4 million. Then we had that really big bounce, right? We had mortgage rates fall from 7.37 to 5.99%. It gave us one of the biggest month-to-month prints ever in history. As you can see, that one dot get up to 4.55 million and then stopped, right? Why? Because mortgage rates started to go up. So mortgage rates went from 6 to 8% the entire year. Home prices still grew, but home sales are still hovering around this 4 million level. We have over 157 million people working in a population of 335 million. Rates go lower, demand will pick up. It's really that simple. All these black lines I draw in, 2013, 14, everything, the 10-year yield went down, and then the 10-year yield went up, demand goes down, 10-year yield falls, mortgage demand picks up because we're back to a very normal functioning 30-year fixed mortgage. That means the 10-year yield mortgage rates matter more than ever. We get lower rates with duration, sales are going up because sales are historically at the lowest levels ever, especially when you tie it to the workforce. Next chart. Now, this is purchase application data. This is the MBA's weekly index, one of my favorite data lines to track. As you can see, the market of 2002 to 2005, unbelievable credit boom. That market will never come back again, especially with qualified mortgage. There's no more option arms, interest-only loans, anything, stated incomes. That is done with. Very slow and steady, going up to years 2020 to 2024. And then as mortgage rates and home prices escalated out of control, another sharp crash. But again, we're bottoming out here, and that slow dance, right? That 10-year yield falls, mortgage rates fall. We should grow this. Now, I'm not as bullish as maybe the NAR and other people, just because I don't believe mortgage rates can go down fast enough for this year, but we can grow sales easily as long as rates stay lower and they don't go higher. This is where I have a big problem with the Federal Reserve. They don't need to be hawkish. The growth rate of inflation has already fallen, right? So they're keeping the 10-year yield and the Fed funds rate, or they're still being overly hawkish. A lot of people think the Fed just pivoted. No, they didn't, right? They're still very restrictive. Hopefully, as time goes on, they can change before the economic data gets weaker. But every single time the 10-year yield falls, this data line improves. I track this weekly for over 13 years. It's very easy. You noticeably see a difference in purchase application data when the 10-year yield and mortgage rates fall or the 10-year yield rises, but we're at such low levels. And again, over 157 million people working, a country of 335 million people. That's how low sales are. So we're kind of bottoming out. We get the 10-year yield to go down, mortgage rates fall. This can increase. Also, you get more refinances and purchase together. Volumes and incomes can grow in 2024, just because we're working from such depressed levels. Next chart. Now, there is one sector of the economy that actually did grow in housing, new home sales, even though the last a few months got impacted with 8% rates. The builders are growing at double digits last year because they could offer sub 6% mortgage rates, right? A lot of people didn't understand is the builders are here to make money. They're not the March of Dimes, right? They're here to build homes and sell them. So their profit margins were really good. So they're like, oh, there's not a lot of inventory. People are going to come here, right? So we're going to offer everyone sub 6% mortgage rates. If we had sub 6% mortgage rates the entire year, existing home sales are noticeably growing from these low levels. But the builders were able to do this because their business model is a little bit different. Existing homes is basically a seller and a buyer, transfer of commissions. You have normal people. Here, builders sell their homes as a commodity, right? There's no one living in them. They just build these homes and get them ready, and then they sell them. So their job is to sell as many of their homes as they can. So they'll offer lower rates because their main competition is the existing home sales market. Next chart. And where the builders actually had some stress was their monthly supply data actually spiked. Now, a lot of people didn't understand when the monthly supply for the builder spikes, this doesn't really mean a lot of inventory comes to the market. It just means that their homes under construction are the monthly supply picks up. So they were kind of forced to make sure that they can lower rates to get deals done. The builders do not flood a marketplace. Now, the existing home sales market, the monthly supply is 3.5 months. Here, we got even above 10 months. So there's a huge difference between the builders and the existing home sales market. And the next chart's going to be very interesting. I always tell people when I'm at these conferences, I go, does anybody know how many new homes are available for sale? Everybody has a normal life. Nobody's a nerd like I. Nobody knows this. And I go, as of today, 78,000. That's all the new homes that are completed and available for sale. And people think like millions of homes are coming to the market. No, even the housing bubble crash years, this data line never even got to 200,000. So I realized not a lot of people have read a new home sales report in the last 15 years. They do not ever flood a market. They manage their supply so they can sell homes at the highest price possible so they can make money. So even with monthly supply getting above 10 months, their completed units, it's only 78,000. For a country of 335 million and over 157 million working, that's all we got. 78,000 new homes available for sale. So the builders don't ever flood a marketplace, but they manage it. They'll cut rates. They don't like new homes completed staying on the marketplace for more than 3 months, right? So they'll make deals to sell homes. And this is why even today, with monthly supply as high as it is, we only have 78,000. And we got to remember the housing bubble crash years were such an anomaly, and there's going to be a lot of charts that are provided here that'll explain it, and you could show clients and friends and everything. That marketplace can't really come back because the credit market is different. But here, everyone can see that's all we got, right? This is not the sector to think about a lot of completed units, unoccupied homes coming to the market. It never was. And even in the worst period in recent history, it never got to 200,000. Next chart. So this is one of my favorite charts. This is the National Association of Realtors active inventory going back to 1982. I draw these black lines every single year to give people a perspective. History has shown us we're typically between 2 to 2.5 million. That's what we have for decades. As you can see, the peak was in 2007. Not a lot of people know this, but the peak active listing was in 2008. It was 2007. And we have been in a downtrend for a very long time. Even with the biggest and fastest home sale crash ever recorded in history, that's all the inventory we got. Why? Because the credit markets changed. After 2010 qualified mortgage, most people get 30-year fixes. Everyone qualifies for it. Homeowners are not what I call middle-aged men stock traders. Middle-aged men stock traders think that people buy and sell homes because of the asset value. No, they buy a payment. So what's the awesome aspect of housing? The 30-year fixed payment is literally golden. It's a fixed debt cost and your wages rise every year. So over time, your house value compared to your wages is less. So here we are for many, many years. Demand is picking up everything. Inventory has been slowly falling. Buyers, housing supply is a function of demand. Most sellers are buyers, right? When they list their homes, they buy another one. That's been the marketplace for decades. But what buyer doesn't offer you inventory? First-time home buyer, right? The millennials were the biggest home buyers in years until rates went up. They started buying in 2013. So they're slowly taking some of these products off without giving you everything. So you can see this downtrend. But if you look back in the year 2000, inventory grew for 5 years with sales rising, different credit market. Anybody can buy and sell a home back then. There was no stress, no nothing. And then we saw the escalation in inventory. There's going to be some charts to explain this. Different marketplace. I'm dead serious when I say this. The housing market of the last few years is the exact opposite of the housing bubble years. And here's the evidence, right? So even with the biggest crash in sales, inventory barely grew, right? On the NAR data. So the reality is everybody is not locked in. Everybody just buys a home and lives in there, and they go to work. Their kids go to school. The housing sector doesn't revolve around like a lot of financial instruments out there. So it shouldn't shock anybody that inventory didn't escalate. That's been the trend for a very long time. Next chart. So for us at HousingWire, Altos Research and HousingWire joined together. We have the freshest, newest inventory data in America. We have an unfair advantage over everyone. By the time we get the data and look at it, by the time most people, it takes months for the sales data to catch up to us. This is why our work has been pretty popular. This is the new listings data. These are homes that come onto the market every week that don't go into contract. 2021, 2022, and 2023 are the lowest levels ever recorded in history. To give you a really good example, Mike Simonson, the president of Altos Research, and when he started his company in 2006, he went to Wall Street in 2007, talked to Lehman Brothers, told Lehman Brothers, listen, I have a data line here and it looks like the housing market is breaking. Lehman Brothers says, oh, who are you? I have 85 analysts. Mike Simonson went to Goldman Sachs, showed him the same data. Goldman Sachs said, oh boy, we're going to short the housing market. Goldman Sachs made $10 billion. Lehman Brothers went out of business. This new listings data, back then during the housing bubble crash years, these are weekly data. To give you a good example, this last week we had 35,000 new listings. This data line was running at 250 to 400,000 per week. We've barely even broken above 90,000 during this whole period. A lot of people thought in 2021, oh my God, nobody listed their homes in COVID. Mortgage rates are down. Everyone's going to flood the market in 2021, forbearance, everything's going to crash. No, it didn't. It's basically been trending at all-time lows. Why? People buy a home, they have a 30-year fix, they live in there. They're not stock traders, right? There's nothing that we have seen. This data line took another leg lower after July of 2022. Mortgage rates got above 6%. Supply is a function of demand. So mortgage rates are too high for sellers to become buyers. We took another leg lower during this entire time where people talked about silver tsunami, Airbnb crash. For the last 18 months, this data line has been trading at the lowest levels ever recorded in history. And we have over 157 million people working and a population of 335 million. This data line, though, should grow in 2024, right? As more people list their house to sell, this data line should pick up. If there's any kind of stress in this data line will go straight vertical like we've seen over the last 15 to 20 years, right? So we don't see any stress here, but we do see that we're just working from the lowest levels in histories. And just remember, sellers are buyers. They list their homes. Everyone is qualified, right? Everyone goes to the mortgage people. Can I buy a house if I list my house? Yes, you can. If mortgage rates are 7%, you're good. 8%, no. So everyone has a better idea of what happens. This is one of the reasons why new listings data the last 18 months has been trending at the lowest levels ever. People can't afford, right? It's not so much of a mortgage rate lockdown. Literally, people can't afford. You don't sell your house to be homeless. That was a very interesting concept that people actually convince other people that people sell their houses to be homeless. No, a seller has to acquire another form of shelter. Most of the time they're buying. This data line should be able to grow. This will be a positive for the housing market, we think, in 2024, and especially if mortgage rates start to come down even more. The new listings data will have problems growing if demand really picks up. But here, as you could all see, all this hype about Airbnb crash and everything, nothing. It was never in the data. Why? One of the things I always tell people, reading is a good thing. Right? The history of human civilization has always taught us those that read will always have an advantage over those who don't. This is the data. We are the only people that have this very fresh. I get it every Friday morning, Saturday morning. I write these tracker articles to keep everybody on par with what the current data is. Because if you're waiting for existing home sales data, you're months behind. And that's what happened last year is that on November 9th, 2022, I talked about the housing dynamics have shifted. Home prices aren't going to crash, but by the time everyone realizes this, it'll be 4 to 5 months out. And that's what occurred. So we've got the data. This is a very new data line for a lot of people I know. But if we ever see stress in the data, this data will go vertical. A good example is the peak inventory is usually June and July. The peak inventory never really broke above 90,000 here. During 2010 and 2011, it was running at 370,000 to 400,000 per week, right? That's how much new listings were coming, distressed sellers. We didn't see any of that for the last 3 years. Next chart. So our inventory data is also more different than the NAR's inventory data. The NAR takes single family homes, condos, everything's pending sales and everything. So their number is always higher. This is the active inventory single family that is available for sale. As you can see here in 2022, the slope of the inventory curve was faster than normal. Why? We had the biggest home sale crash ever recorded in history, right? But when home sales stopped crashing, inventory data stabilized, right? So it's in our weekly single family. As of right now, today, we have 499,000 single family homes available for sale. That's it, right? These are homes that are not in contract. We have the weekly data. We track them. We have every single zip code. Altos Research can give you your own zip code with listings, median price, everything that you want, but it's also ahead of everyone else. So here you can see this downtrend, like in all the inventory data. We saw the collapse in inventory in 2020. But even with the biggest home sale crash ever recorded in history, that's all we're not even anywhere close to 2019 levels on a national basis. And as demand stabilized, the slope of the inventory curve changed. That's a huge thing for us. That's how we track the weekly data to see stress. And even with mortgage rates getting to 8% last year, we saw a very, very noticeable thing that we think was the story of 2023 that nobody really talked about. The next chart, we'll kind of go into that. 1/3 of all homes in America get price cuts before they sell. It's something that not a lot of people know. Like these professional grifters, these YouTube and TikTok accounts, they always take these snapshots of Redfins and they go, "Oh my God, these look, prices are crashing and everything." No, 1/3 of all homes get it. As you can see, the slope of the price cut percentage curve grew with the inventory. That was 2022, right? The biggest home sale crash, mortgage rates went from 3 to 7%. More people had to cut prices to sell their homes. That all changed when demand stabilized, starting from November 9th, 2022. Even when mortgage rates got toward 8%, the price cut percentage was always 4% below the previous year. That's telling you that home sellers are not panicked, they're not stressed, right? Nobody ever talked about this last year, even though I went on TV and said, "Hey guys, literally the price cut percentage is down year over year." So as of right now, the trend is, this is a very seasonal data line, as you can see, price cut percentages are actually going to fall below 2023 levels as this trend continues, right? Why? Because home sellers aren't stressed, active inventory is low. You guys all see the active inventory levels. Just remember, we have over 157 million people working, a population of 335. There's not that many homes out there. There are home buyers out there that can buy homes even with 8% mortgage rates. So there's just, it's kind of like that 80s game, Hungry Hippo. There's not many balls out there, right? So this is the way I could explain why the price cut percentages are actually declining and are going to decline over the lows of 2023. So it was a total shock to everybody that home prices not only did not crash in 2023, they rebounded very quickly. So how is that possible? You guys all have seen this. New listings data, active listings data, price cut percentages. Sales aren't crashing anymore. So if people are thinking that home prices are going to crash like they did in 2008, you don't have the active listings, you don't have the stressed sellers, and you have stable demand. We look back in the history of economics for 500 years. There's been nothing that we have seen where you have stable demand and low inventory and prices crashing. It doesn't exist, right? As you can see, inventory escalated out of control from 2005 to 2007. We have a lot of stressed sellers. But here, how did prices get back? Price cut percentages were falling, right? And we are going to break under the lows of 2023. And if mortgage rates go lower, demand picks up, right? That relationship, that slow dance between the 10-year yield and 30-year, right? So we put these all together every single Saturday. We're ahead of the curve. We want you all to be ahead of the curve so you don't get stuck like a lot of people did in like June and July. Like, why aren't home prices crashing? You don't want to be old and slow. Like 1,000 years ago, you have to dispatch horses to go to another country to get information. And a year later, when they come back, they'll tell you you're about to get invaded. Here, you don't have that. We have the internet. You can all get access to this data. You all can read, and everyone can understand what's going on with the housing market. You don't have to be looking at people at YouTube or TikTok or Twitter or anything like that. Those people are trash. It's grifting. Here's the data. The data will guide you there. Next chart. This is my money chart. Everywhere I go, how many people think it's housing 2008? There's always an Uncle Dave everywhere. Housing's 2008. Okay. Cute, adorable. If you notice here, 2005, 6, 7, and 8. Bankruptcies, foreclosures were all rising when the economy was expanding. The unemployment rates were falling. All this happened before the job loss recession in 2008. Why? The credit markets were much different. If you guys could see, there's a lot of bankruptcies early on in the century. There was a 2005 bankruptcy reform law that put into place. A lot of people wanted to file for bankruptcies before that law took into effect. And then we had exotic loan debt structures. So here, the data was very evident. The credit markets and housing were breaking before the job loss recession. None of that's been happening for 13 years. Reading is a good thing. If you can't read, I draw these black lines always. We had some very popular podcast guy say last year, 700% increase in foreclosures. See that little black line? Too small. Can't get the job done. There's your foreclosure crisis, right? The data was evident back in 2005, 6, 7, 8. The data has been evident for years. Why? Everybody gets 30-year fixed mortgages. There's no more option arms. There's no more exotic loan debt structures in America, right? People don't sell their homes to be homeless, right? They're in a very low housing cost environment. Most people are living in their homes longer and longer. So while it was very apparent back then, there's nothing recorded in history in the last 13 years to show that it's the same marketplace. So now, connect the dots. I always say, connect the dots. Be the detective, not the troll, right? You want to know why inventory is falling? Everybody's good in their homes. It's a home. You live in it. You don't trade it like a stock. So foreclosure data will get back to pre-COVID-19 trends as the forbearance data. Now, forbearance itself was, I coined the phrase forbearance crash bros. You want to see the biggest professional grifters where these clowns running around and saying forbearance was get to 15 million while the job market was recovering. It's funny. People that made over 60,000 got all their jobs back by October 2020. And these people are saying, oh, forbearance is going to take up. No, why would these people like sell their houses? They got their jobs back. Forbearance itself crashed. There's like maybe 120,000 homes still left in forbearance, right? Reading is a good thing. So here we are. This is the money chart. Take this, show everybody. You cannot have a 2008 housing credit crisis again, right? It's much different this time. Next chart. And also, when we think about foreclosure crisis, always remember this: 30, 60, 90-day, 120-day rates are all near all-time lows, right? So foreclosure process is going to take 9 to 18 months for that inventory to hit the marketplace. So when we're already working at the lowest levels ever, 2025, maybe 2026, if there's a job loss recession, it was always in the data. Since the credit markets have changed after a qualified mortgage, you're going to need a job loss recession to happen first. And then we start to get the real big increases in 30, 60, 90 days, 120 days, notice of defaults. Some states, judicial states, it takes longer to foreclose. You might have 3 years in some states where you can get a foreclosure process into the marketplace. We're good here, right? We've always been good. Why? The credit markets changed after 2010. In fact, not only the housing market, the U.S. economy changed with the bankruptcy reforms laws in 2010. So we are good here. You have the data. Every quarter, this gets updated. When a job loss recession occurs, then we can address that. When jobless claims break above 323,000, we'll address it. But as of now, nothing in the data was showing credit stress. So now you get to see why inventory wasn't rising as much, even with the biggest home sale crash ever. Next chart. So the 30 and 60-day lates, we do see an increase. I do believe we get back to pre-COVID-19 trends here, but very small, right? No stress in the system. A job loss recession, when it occurs, then we can go there, right? Because people will lose their jobs. They can't make their payments, right? They'll get 30-day, 60-day lates. There's a lot of nested equity. One of the things I talk about when I speak live at events, I always go, does anybody know how many homes in America, what's the percentage of homes that don't have a mortgage? It's 42%. 42% of homes don't have a mortgage. Now, we have the best loan credit profile ever recorded in history, not only in America, but on planet Earth. And we think it's going to be 2008 again? Doesn't work that way. Late cycle lending is a risk. People with very low down payments, that they lose their jobs, especially if they're single income, don't have a lot of selling equity. But the selling equity portion right now is the highest levels ever recorded in history, because almost half the homes don't have a mortgage and there's so much equity already built in. There's a cushion there. So the foreclosure data is not going to be the same. Even if people lost their homes, they do have equity to sell. Next chart. FICO scores. Oh, I love this. Literally every time I speak at a conference, I sit there and look at this chart. It's so beautiful. I pause. Look how beautiful that is. After 2010, when qualified mortgage came in, it's looked great for 13 years. Why? Because traditionally speaking, struggling cash flow people don't buy homes. It's never been in data. During the 1996 to 2005 era, we had more of those because there was exotic loan debt structures, not the case. Now, this chart also confuses a lot of people because you see this explosion of people with 760 FICO scores. People go, oh, that's FICO score inflation. Something's wrong. No, it isn't. It's literally been the same for 13 years. It's just that we were originating more loans during COVID, right? We not only purchases were high, but also refinances. The homeowners in America have never looked this good, right? This is a beautiful looking chart. And this is, I'm coming from a family that's been in banking since the late 1950s. You have never had homeowners on planet Earth have such good nested equity or cash flows, right? Because what is it? The 30-year fixed mortgage, like everyone hates us because of this, because the world can't replicate us, was designed for a fixed debt costs and your wages rises and the cash flow looks great, right? This has always been here in the data for years. And I'm still even puzzled today that people think that Americans are struggling, or, and you know, the default rates are low, the new listings data are low, the FICO scores are great. Almost half homes don't even have a mortgage. This is it. The FICO score inflation garbage that you hear out there in terms of homeowners is not the case. This has been the same for 13 years. Reading is a good thing. This is a beautiful chart. Show it to everybody. It shows that cash flow is doing good. Next chart. Why? Okay, mortgage debt service payments, that's a percentage of disposable income. Wow, this looks so different than 2008, doesn't it? Exotic loan debt structures, mortgage rates are high, recast rates here different, right? We deleveraged a lot of exotic loan debt, fixed debt cost, rising wages. What's the best hedge against inflation on planet Earth? It was a 30-year fixed mortgage. Why? Because during an inflationary time, your wages actually grow, right? If you're a W-2 person, your wages increase to match the cost of living, right? Your 30-year fixed mortgage that a lot of people have had. Remember, we've had 3 refinance waves since 2012, 2016, 2020, 2021. Fixed debt costs, your wages rise, your mortgage debt cost is low versus your total income. And this is the key here. From 1985 to 2007, people were living in their homes 5 to 7 years. From 2008 to 2024 now, depending on who you listen to, it's 11 to 13 years. Some parts of the country, 15 to 18 years. I've lived in my home for 20 years, right? My, wages do not, your wages aren't the same like you were in 25, right? So the longer you live, your wages, your total incomes are higher. And a lot of people refinance too. So very, very low housing costs to relationship to your total wages, especially is in your 40s and 50s. And then we have all these people who don't even have a mortgage on their homes. This chart everyone hates, right? So it makes sense, especially when you think about all the debt that we deleverage and all the refinancing out there. So you can understand why the FICO score data looks good. You can understand why the credit markets, there's no stress in the marketplace. You can understand why new listings data isn't exploding higher. Homeowners are doing great. Next chart. Now, the world hates us chart right here. There are so many countries out there that are dealing with financial and housing stress because their mortgage markets are tied to short-term rates. You can see the United States is the best in the world. So people hate us already, but they really hate us for this. Other countries don't really have like a 30-year fixed. There's no FHA, there's no Freddie or Fannie or VA or FHA. So they're tied to short-term rates. Now, for a long time, a lot of these countries, their home prices were growing much faster than US. In fact, the US is cheap compared to Canada, Sweden, Australia, Norway, but they were tied to short-term rates. So their mortgage rates are lower. But guess what? Now that short-term rates have risen, they have to refinance and everything. Right now in Canada, somebody's waking up and their home total mortgage payment is almost double. In Canada, they're talking about 90-year mortgage loan modifications, right? Because their costs, I mean, their home prices have escalated so much higher than ours, and now their short-term rates are recasting and everything. So these countries are in trouble. Not the case, right? All those charts that I showed you right there, right? Connect the dots, be the detective, not the troll. 30-year fixed product, fixed debt cost, rising wages. Almost half the homes don't even have a mortgage. FICO score looks great. Delinquencies are low. There's no job loss recession yet. We are the king of the world in terms of housing credit. And it's all because of the 30-year fixed mortgage. These countries, not so much. They've got issues, right? So blessed that we got this product, but it just shows how different we are than everyone else. And now I've showed you a string of data out there to showcase that, hey, this is not anything stressful. When a job loss recession happens, okay, we'll go there. We'll have that discussion every single week, every single day, but not yet. Next chart. Mortgage credit availability. So during the housing credit boom, you guys saw that MBA purchase application chart. Credit was booming back then. That was because credit availability had to keep on growing. As you can see here, it exploded, right? Home sales were keeping at bay just because credit was. And then we had the massive collapse, right? And you can see this, a lot of housing charts look like this back then. New home sales crashed 82% from the high. We cannot get very tight or very liberal with credit anymore, right? And a lot of people saw the credit availability index fall after COVID and said, oh, how demand's going to be shot. Credit is getting tight. No, it's pretty much 30-year fixed mortgages. It's just the 10-year yield and 30-year mortgage. That's what drives everything, really. So credit really can't get tight, really can't get loose anymore. So a lot of people say, well, mortgage rates fell during 2008 and, home sales. No, well, that marketplace was much different. Also, you have to remember that back then we had underwater mortgages. People couldn't sell their homes, right? And buy another one because they didn't have enough equity. We don't have that issue anymore here, right? Especially now that home prices went up again in 2023. So there's a lot of selling equity. 10-year yield falls, mortgage rates fall, demand should pick up. Back then, not the case, right? This data line, so much leverage credit during the housing market back then, not anymore. We're pretty vanilla. Vanilla is a good thing. Boring is a good thing for credit debt in housing, right? And you could all see this now after the longest economic and job expansion history, fixed debt cost, rising wages. Homeowners are doing good, right? Until they lose their jobs, they're not really forced to sell. Next chart. Yeah, when everybody says the US is broke, it's hilarious. You take our total assets as a country, it's over 171 trillion, right? Mortgage debt is the majority of all consumer debt. Now you can see fixed debt cost, it's the payment actually that makes it great. But on top of all that, we have the housing market is $52 trillion really in financial value. We're like, just our home values is almost double the economy of China out here. But not only that, if you see here, since majority of all consumer debt is tied to 30-year fixed mortgage, the debt payments as a percentage of disposable income is still low, right? So a lot of people think, oh, there's credit card debt's rising. Credit card debts always rise in every expansion. If it's not rising, it's a bad thing, right? So if people are understanding why is the economy is expanding, the people that have the most debt, the most consumer debt, are also in the best financial position, right? Because mortgages. Like somebody getting $1 million mortgage right now, oh, they're poor. No, they're not. They're making $300,000, $400,000, $500,000, and they have a lot of financial assets. So here, hopefully, this could give you everyone an explanation of how homeowners are doing much better than renters. Renters have a different problem, right? Because rents go up, rents keep on going up, right? And rent inflation really took off during the global pandemic, which is actually very normal in global pandemic. Shelter inflation takes off and then disinflation. You don't have that fixed cost here. Now, we have other issues in housing, of course, insurance, especially Florida, Texas, and in California. That is an issue, but assume this, let's say your insurance goes up $1,000 a year. Just for 1 year, that one increase, you average out for 12 months, you see the cash flow. A lot of homeowners can take that cost. A renter, though, that's a different story, right? Rents go up. The history of rental deflation is not after World War II. We don't usually see that. So let's not mix homeowners that have been living in their homes for 15, 20 years that are doing really good compared to young single household renters, right? Two different dynamics. Here you could actually see the US 171 trillion of financial. We're not poor, we're not broke. Homeowners are in a much different spot than renters, or again, against anybody else on planet Earth, because it's a fixed debt cost and your wages rise and people live in their homes, right? They're not stock traders. Stock traders will sell their houses because they look at it as a financial asset. No, people live in their homes for their total cost. And as you get older, your wages grow, your incomes grow, but that 30-year fixed payment stays the same. And then it actually goes lower in value as your wages rise. Next chart. Okay, so does everybody remember the housing bubble crash people were talking about in 2022? If you take a little look, if you need like glasses or anything, that decline in the second half of 2022, that was it. All that talking, all that, here comes a bubble crash. Now, when you look at this chart, it looks crazy, right? It looks like, oh my God, home prices escalate. Yes, it did. It escalated out of control. Why? All those inventory charts I showed you. What happened? We broke to all-time lows in the worst time ever. Like, I've been talking about years 2020 to 2024 for like 10 years. I've been waiting for this period, and then I kept on seeing inventory go lower and lower, and I'm like, oh boy. By the summer of 2020, we were in a really bad place. Why? There's 157 million people working. The low point, this is the crazy stat I always tell people. In the March of 2022, we only had 240,000 single-family homes available for sale. That's it. So when people say, how did prices get out of control? Too many people chasing too few homes. Not like the housing bubble years where credit was available, right? Everybody was getting into homes, exotic loan debt structures, then inventory skyrocketed. The exact opposite happened. So if you're confused about why did home prices rebound so quick, same thing. Inventory's low, demand stopped crashing. Homeowners are doing very good. Price cut percentages are about to go below 2023 levels. Why? All of you have now seen this data. And that explains how home prices within 6 months got back to all-time highs toward the end of 2022. You connect the dots together, right? If we see stress in the data, you'll see delinquencies rise. You'll see new listings data rise. We are going to be there because we get the data first. And every Saturday, I'll present it out to everybody. But the home housing bubble crash for like 13 years that people have talking about, this is what happened. Why? They don't read. Reading is a good thing. We have the data. The data will always guide us there. You could see what happened 2005, 6, 7, 8. Boy, credit stress, inventory, everything. Then the job loss recession happened. The exact opposite. You cannot get two different cycles over the last 300 years that have been any different than the 2000 to 2008 market, than the 2012 to 2024 market. Completely different dynamics because of credit. Next chart. And you can really see it versus rent, right? The red line is the owner equivalence of rent. There are 1/3 of the population are going to be lifelong renters, right? Unless they get part of a dual household income. So that rent, we don't have like major rent deflation, like rents just crashing down because most people are always working. But home prices, though, boy, if inventory breaks, you could see what happened. We have such a big deviation from rent. Now, for every year, 2012 going to 2023, everybody keeps on telling me this data line has to go back, touch to rent, because that happened in 2008 to 11. Well, that's cute. Fine. Give me the inventory levels back then. Never happened. Right? I always say the housing bubble boys. I have this lovely relationship with these guys. For 12 years, they kept on talking about home prices crashing because this data line has to come back to that rent. It has to. Well, okay, fine. You have to give me the same supply and credit data back then. Never happened. So not only did home prices escalate in a period where people thought home prices were going to crash in COVID, forbearance, highest mortgage rates in decades, low housing demand. What happened? Supply and demand economics matters. It's always mattered for centuries. But here, people just needed the right information. Not a speculative theory, but the right information. That's my job. My job is to basically relay to you what the data is telling you. in a way that it's easy to understand. And then you could talk to your clients, friends, and that Uncle Dave that keeps on telling you Housing 2008. So then everyone could be a housing expert, right? Because a lot of the other stuff has been trashed for a while because it's a speculative theory versus data. Data always wins at the end. And now this presentation, you all have this information for you. You'll get the charts. And every single Saturday, I will update all the data because we get it first. You don't want to be months behind, like waiting for the existing home sales, but you connect it all together. This explains the craziness of post 2020, right? Home prices escalating out of control, even with record-breaking mortgage rates in a very fast fashion and crashing demand. Supply and demand economics works. Credit data looks excellent still. The US is not in a recession yet. These variables can change, but these core things can't. Next. So for HousingWire, if you wanted to get all the information, this is a QR code, HW Plus. I do the tracker every single weekend. I write about all the housing and economic reports in here as well. But the tracker is designed to take a few things: 10-year yield, mortgage rates, purchase application data, new listings, active listings, price cut percentages. You put them all together. I always say this stuff has worked since the Peloponnesian War. If variables change and changes the data, we go with it. But what occurred was that last year, even with mortgage rates getting toward 8%, we noticed that the data wasn't changing like people thought. So here we are today going into 2024, and the price cut percentages are actually going to start to break, right? So if you don't have this information, you wouldn't know. If you're listening to the media or crazy people on YouTube or TikTok is trash. You wouldn't, there's a difference, right? This is what the data is. This QR code gives it to you. If you join HW Plus, I will guide you every single day because I do not do anything else but this. This is my life. I retired. This is all I do is look at charts all day and night. I don't hardly even sleep. But I take pride in my work because I don't want to be wrong. Everyone loves to be wrong, but try to look good. The data will tell you this. If something changes materially, we will go with it. 10-year yield, new listings, purchase application today, but we will guide you through the process. That's how it's worked for decades, right? Now that the data is available for everyone, you don't have to wait 6 months for an existing home sales report to tell you what happened. Our job is to get you ahead of the curve. Next chart or next slide. Altos researched this QR code for those that want specific information for your own zip code. Mike Simonson and his team, he's got 8 data scientists who are just as nerdy as I am. They look at everything in your area. They tell you how many homes go into the market, what's the list price, what it is. They even create little data graphs for you guys to actually sit there and tell you if it's a buyer's or seller's market. It's the freshest, up-to-date information with what's going on per week. So you don't get behind the curve. For those that wanted to get that information, this is the QR code for that. And for everything else, hopefully, I explained it in a way to show you. My job is to connect the dots, right? Be the detective, not to troll. All this data has been here for years. It just needed to be explained in a fashion to make sense of the mass. And let me tell you, everything has been crazy after 2020, right? COVID has done things to economic data that we all couldn't imagine happening unless it was a global pandemic or a world war, right? And we're getting back to normal, but certain things can't change, right? Demographics can't change, credit data can't change, but we track everything. I'm an economic cycle person first, housing person second. So I look at commodity prices, bond yields, there's so many things that I go into. My job is to kind of tell you. We have a podcast, a top 10 business podcast. Sarah Wheeler and I do it twice a week, Thursdays and Mondays. There's even a YouTube channel for it. My job is to tell you the information for the week, what to look for in the future. And the tracker article is here to give you the charts, right? So you visually can see the things. And if you need clients to see this, you could show them this. This is what I do when I tour the country. I give all this stuff and I realize not a lot of people have seen this data or it's seen the data and then presented. My economic friends are boring. So I apologize if you've fallen asleep with some of their talks. That's on them. So I'm trying to keep this as entertaining, as active and energetic as possible. If you have any questions, feel free to ask. I love questions more than anything else.
Logan, that was fantastic. And I know, Emily, I don't know if you want to go first or if you want me to
You go
jump
right
in.
ahead.
We've got a lot of questions coming at you. I did see one that just kind of popped up about your podcast. If you could kind of give the name of that podcast again, that
So
would be great.
Housing Wire Daily. Housing Wire Daily is a daily podcast. Our podcasts are twice a week. We come out on Thursday and Monday. Sarah Wheeler and myself. So twice a week. Uh, if anybody has Instagram, if you really want to nerd out, my Instagram stories are not like fun and exciting, but I literally go over all the data on my Instagram stories. I'm the biggest nerd out there. I don't do anything else. So if you have an Instagram account, you could follow the story sections. Thousands of people go there. We go over all the data, but the podcasts come out Thursdays and Mondays, Housing Wire Daily. And also, if you prefer YouTube, Housing Wire just opened a YouTube channel, Housing Wire. You could go there, and both the podcasts will be there in a YouTube form as well.
Fantastic. Well, we have a number of people that are still on with us, and we have a number of watch parties as well. So with your watch parties, don't forget to send your any pictures from those to AB Webinars, abwebinars at atlanticbay.com. I think Thea put that in the chat as well. And the next question that we had, and then I'll let Emily ask a couple. We had a question from Eric who asked, how does Wall Street, i.e. like Bezos and et cetera, purchasing so many residential homes affect the overall inventory of data? And is that something to still be concerned about?
This has been one of the biggest false narrative talking points for 12 years. Wall Street, that's it. They are one of the smallest percentage of buyers in America this century, but they get the most play. Why? Because Wall Street, class warfare, those people. So just to give you numbers, from 2011 to 2017, if I took all the Wall Street and pension firms together for buying for rent, 200,000 homes out of 36 million homes that were bought. That's all. If I take COVID, Wall Street, institutional investors, those that are 1,000 and above homes, they went from 0.4% to 2.1%. That was it. They get a lot of play, right? There's certain areas where they're doing it, but they're actually buying to rent out homes. Flippers are different. Now, mom and pop investors are a majority of all investors, but you can't say mom and pop investors. You don't get that class warfare if it's like your neighbor, right? So we give a lot of attention to Wall Street. And the reason I do this is because a lot of people say home sales can never go down because Wall Street buys this small. That's all. They are the smallest buyers outside of foreign buyers. So the iBuyers were even less than 1%. Most of them are done. There's only a few companies left. So they are, in some areas, they've bought a little bit more single family rentals, like Blackstone. They own like 0.02% of all the homes. There's over 146 total housing units in America. They are the smallest owners out there, but they get a lot of play just because it's Wall Street. So they are not that big. They haven't been really buying as much lately either. But in certain pockets, they did buy some stews. And this is also the Airbnb story as well, just to give people some numbers. Airbnb went from like 800,000 to almost 1.2 million. So if you think about 146 million housing units out there, Airbnb is less than 1% as well. There's a lot of stories out there that get a lot of play, but the data doesn't warrant it. Mortgage buyers, primary single, they run the market always. They're the biggest buyers. Investors, mom and pop investors, especially those that own 1 to 9 properties, they're the biggest ones. Wall Street is the smallest player out of them. It gets a lot of class warfare clicks, but the data has never shown this. And I say this because a lot of people said home sales can never go down because Wall Street's buying them. No, it's trash. I mean, even just like a few weeks ago, there's a report that said they bought 44% of the homes in 2023. There's so much bad information out there on the internet. But I've even wrote an article about this on Housing Wire. No, Wall Street's not buying 40%. And I even show the charts and I break them down from people that buy 1 to 9 homes or 10 to 99, or even the institutional buyers out there. They're just not that big. When you think about, we're going to have 5 million total home sales in 2023. They're a very tiny percentage of the buyers out there.
Fantastic.
And I'll kind of add to that because I know you love this one too, because we do have a question around how you see the inventory changing when boomers start to sell and your silver tsunami. So I
Oh,
don't know
the
if you want to address
silver.
that on top of it.
Yes, yes. The silver tsunami. There's a podcast I did recently on HousingWire a few days ago on this. The silver tsunami has been one of the biggest trash economic theories for a long time. And I'm going to explain this why. In 2008, the first baby boomer hit 62. So the silver tsunami was actually supposed to be a 2015 to 2025. All the baby boomers were going to sell their homes to millennials who couldn't buy them, their McMansions, and home prices were going to crash. That was a 2015 to 2025 story, because by the time the 2015 came, the baby boomers were 69, or that wave was supposed to happen already. We are literally in 2024, and the new listings data is trending at the lowest levels ever recorded in history. And they use this 30 to 60 million active listings. You guys saw that NAR chart. We're at 1 million active listings. 2007, it was 4 million, right? Credit stress here, even with the biggest home sale crash, we're at 1 million. So the silver tsunami was a marketing gimmick by Wall Street, YouTubers, and everything. It never happened. It was actually, this is supposed to be the last 2 years of the silver tsunami. And as you can all see, the new listings data is trending at the lowest levels ever. So sellers or buyers, baby boomers love their homes, right? They're free and clear. And they have shown us that, they're going to stay there until death. Now, down the line, everyone dies. Nobody's Dorian Gray. So when the baby boomers pass their homes off, they give it to their children. What their children to do, we can speculate, but it looks like a death theory, not a silver tsunami, because this was supposed to be the last 2 years of the silver tsunami, and you all see the data. So there's just so much marketing stuff on housing, Wall Street, silver tsunami. This is why we want to present the data, right? If there was ever a tsunami, the new listings data would go vertical, right? We would see that. We saw that in the housing bubble crash years. Now it's like the lowest levels ever recorded in history.
Well, Logan, I think this one's asking you to fix something more than an actual question. But the question was, why does the Fed control interest rates rather than supply and demand, or ...
The Fed only controls the short-term rates, and when they feel like the economy needs a little bit more stability, if demand is breaking, they will raise interest rates to get the cost of money up. The problem with a lot of people's thinking, so much of our debt in our country is fixed. Like, here's a good example. A lot of people thought companies were going to do bad. Companies have a lot of fixed debt and they don't have to refinance for some time. But now that interest rates have gone up, they've earned a lot more interest on their cash. So in a sense, they've actually benefited because they don't have to refinance any of their debt soon, and they've made more money with rates go up. So it's trying to keep the Fed is very important. I always tell people, if you look at what the U.S. economy was before the Fed was created, it was crazy. There were so many banking crises here or there. Their job is to be the lender of last resort. They keep things at bay. And we've got to remember, their mandate is to price stability and keep employment going well. We had the longest economic and job expansion ever recorded in history in the last decade, with price stability pretty good. Then in COVID, they went all in to keep the economy going. So they're a very important function, but they're also people that care about their legacy. So here, I think that the history of global pandemics, people don't realize pandemics are very inflationary, and you don't need a job loss recession for that inflation to come down. A lot of this is supply driven. In war, if you look at World War I, World War II, inflation took off, right? Because supply doesn't work. People are, we're keeping certain things for our military rather than our civilians. Global pandemics, globalization has made the world a very functioning place. So when a global pandemic comes, things don't work normal. But as we all can see, the growth rate of inflation fell by itself without a job loss recession or without the stock market crashing. Stock markets are up again. Unemployment rates are low. So they're human. Humans make mistakes. I'm hoping that they've realized they overdid it and now they can start cutting rates. So a lot of people thought they won't cut rates until the economic data actually got worse. You got to remember, about 14 months ago, the Fed says they want the Fed funds rate to match 3, 6, 12-month core PCE. That's that growth rate of inflation chart that I showed you. That's running at 2% on the 3 to 6 month, and 12-month is at 3.5%. So the Fed funds rate right now, being 5.25%, 5.5%, is really restrictive. So hopefully they learned their lesson, and 2024 and 2025 can be, let's get rates down. Let's get the 10-year yield down. They can change everything like this, and the housing market could come back. And trust me, I bash them on my YouTube because I know they follow my work, and I know their staffers follow my work. So I let them know all the time.
Yeah. All right. We got one last question for you, Logan, because I know you'll like this one. Can you speak to the mortgage lockdown and the myth or not myth around it?
Okay, this is an interesting topic. A lot of people say there is a mortgage rate lockdown, that people won't sell their homes until mortgage rates come back down to a certain level. Except the data doesn't show this. Affordability prevents people from listing their homes because you can't qualify, right? All of you get your clients, right? They come to you and they go, okay, how much do I qualify? Okay, here it is. When you sell your house, you can qualify. What I don't like about the mortgage rate lockdown is in 2021, people said, well, mortgage rates are low. Nobody listed their house in 2020. We're going to get a mass inventory and home prices are going to crash because everyone's going to list their homes because rates are low. New listings data trending at the lowest levels. Here, the last 4 or 5 months of the year, mortgage rates went up higher. New listings data showed a little bit growth. That was not supposed to happen. The mortgage rate lockdown was supposed to be, as rates go higher, the new listings data keeps on falling. No, we had an affordability hit. Sellers or buyers, there are people literally in the last 6, 7 months that have listed their homes that had 3 to 4% mortgages, and they're buying another one. It's an affordability issue with the total cost of housing, not a mortgage rate. A mortgage rate lockdown is like a doomsday theory, right? Because nobody's going to absolutely ever sell their house to buy another one unless mortgage rates get down to 3%. No, it's not the case. It's the total cost. And this debate, Sarah Wheeler and I have this debate, which I just joined her at a live event. But the data doesn't really verify it. It's a confusing topic because people say, well, mortgage rates have to come down, but we're at very low levels of sales. People sell their homes to buy another one every single month. And when I talk about a mortgage rate lockdown, you got to be careful that 42% of homes don't even have a mortgage. Where's their lockdown? No. So there's more to that story than just that headline. It is somewhat of a complicated discussion, but hopefully the charts show that it's not as viable as people think.
Well, this has been fantastic. We really appreciate you coming on and giving us some extra time. Just some housekeeping items real quick to kind of close us out. Don't forget, if you were at a watch party, please send your pics to AB Webinars at atlanticbay.com. And if you enjoyed this session with Logan and you enjoyed our Engage speaker series, please be on the lookout for future invitations. You'll also be getting the slides and a copy of the recording. We'll email it out to everybody that registered. So you can share this great information that Logan passed along. You've noticed my background here for Lending Forward. Logan doesn't know this, but we're going to get him on our Lending Forward podcast as well. So there you go, Logan. That's your New Year's treat. We'd love to have you on there as well. But again, just trying to put great information together. But thank you all again. I'll let Emily let you close us out.
Now, I just want to say thank you, Logan. Thank you to all of our mortgage bankers, all of our partners that joined in today. It was fantastic information, and we just appreciate all your support of Atlantic Bay. And Logan, thank you again for getting up early and being with us today and give us some great information.
My pleasure. And always remember, reading is a good thing.
Reading is a good thing. Thank you all.